What's up, gang? My name's Brennan. Let's talk about stocks. Today we're going to talk about how a good stock could kind of be a little bit of a dud sometimes. I mean, it happens to the best of us, if you know what I'm saying. So there's a bunch of different ways that a company could become more valuable over time. The two main ways that I kind of split it into are with their assets and with their earnings. The asset side of that is more self-explanatory because when you think about it, as long as a company is acquiring more assets without taking on excessive debt to support those assets, then the company, by definition, kind of just becomes more valuable over time. You know, that's the equity of the company. Now, those assets could be a ton of different things, right? I mean, a common thing we think of is cash on the balance sheet, but it could also be like machinery if it's a manufacturing company, or property, or, you know, a bunch of different things like that. Now, a great example that comes to my mind of the asset story actually comes from my all-time favorite investing book, One Up on Wall Street by Peter Lynch, which is basically the Bible, and it talks about a small company in Florida that was buying up a bunch of farmland. Peter Lynch's friend recognized that the company was selling for $20 a share, but the farmland that the company owned was worth way more than that. Let's read, shall we? I once visited a mundane little Florida cattle company called Alico, run out of La Belle, a small town at the edge of the Everglades. All I saw there was a scrub pine and palmetto bush, a few cows grazing around, and perhaps 20 Alico employees trying unsuccessfully to look busy. It wasn't very exciting until you figured out that you could have bought Alico for under $20 a share, and 10 years later, the land alone turned out to be worth more than $200 per share. A smart codger named Ben Hill Griffin Jr. kept buying up the stock and waiting for Wall Street to notice Alico. He must have made a fortune by now. So that's kind of one way that a company could become more valuable, with of course the other way being the earnings. Now the earnings is kind of the one that most of us think about offhand because the earnings tend to be like right there in our face. You know, you look up a company, first thing you see is the earnings. It kind of makes sense. But the thing with the earnings is that as long as the company is acquiring other assets, then in general, the earnings and the free cash flow of the company tend to go up in lockstep. So like in the case of Alico, right, the one we were just talking about, the company was buying up this extra farmland. It ended up being worth more than $200 a share while the company was selling for $20, but they were using that farmland to make more money by, you know, growing more crops and grazing more cattle, etc., etc. So that's why, like in a perfectly efficient world, if, you know, you have a company with $1 billion in both equity and in earnings, if they both went up by 20%, then the company's stock should go up by 20%. But, of course, as you and I both know, this world is nowhere near perfectly efficient. You know, as we've kind of seen through history, there's plenty of times where you can have a good company with a good stock that just ends up going flat as Nebraska for months or years or even like decades, on and on and on, before giving investors a great return. So let's take a look at some examples on that, shall we? Now, the first example I found was from my man, Warren Buffett, right? So, Warren Buffett, he bought Wells Fargo stock in 1989 for $2 a share. Now, his Wells Fargo stock that he bought for $2 a share in 1989, he held on to. He's Warren Buffett. He's like, all right, I'm holding on to this for, the rest of my life, essentially, was his plan. The problem with that was, in 1990, between January and September, the stock fell 28% while the rest of the market went up. Now, if you're Warren Buffett, you're like, man, this is a tough way to go. Yet, my man Warren, the dude hung on to this stock, right? It went down 28%, rest of the market's going up, but he's like, no, we're good. We're holding on to this for the long term, right? He ended up selling it at the beginning of 2022 for about $50 a share. So even though the stock went from 2 something to like 150 or so, right? It ended up going from 2 to 50 over the time that he owned it. That's earning 25 times your money in 33 years. But that's just one example. So let's look at another one. Peter Lynch, he owned Merck stock in the 70s and 80s. He watched as the earnings for the company went from about 30 cents a share to about 85 cents a share between 1972 and 1981. The entire time, you know what that stock did? Absolutely nothing. Well, I shouldn't say nothing, to be fair. It did go from 11 to 16, and then from 16 back down to about 9, and then went from 9 to 14, and then it kind of went from 14 down to 8, And then it kind of came back up to 9 after like a couple years. But basically over this 9-year period, it went from 11 a share to 9 a share, which is obviously not great. And that's especially not great during a time when the rest of the market was going up. But here's the thing, right? That was 1981. Peter Lynch owned the stock this entire time, and by 1987, the stock was worth $70 a share. To go from 11 to 70 is about 7 times your money in 15 years. Once again, an incredible return, but if you sold just a little bit early, he would have been out of luck, right? And of course, this was during the time when earnings for the company continued going up from 85 cents a share to $2.50 a share. So this entire time, the earnings grew almost 10 times while the stock went up 7 times. Now, before anyone gets mad at me, yes, it is totally possible that a stock could just be so wildly overvalued that it has no option but to go completely flat for years, right? Just look at Microsoft in 1999. Microsoft in 1999 and 2015 sold for the exact same price in both years. That means an investor at the turn of the century could have waited for his newborn child to be able to drive a car before he would have made profit on his investment. I mean, that's like totally ridiculous, right? But when you look back at the data of it, it makes sense because Microsoft at the time was selling for a PE ratio of 65 times earnings, which is absolutely ridiculous considering that the market average PE ratio over the long term is about 15 times. And people are still wondering why these high growth companies with like triple digit PEs are like falling off a cliff recently. But once again, take note, the Microsoft investor eventually did make money on his investment. And not only that, but if he held until today in 2022, he would have outperformed the market from 1999 until 2022, despite being negative for 16 years out of those 23 years. So what's the lesson in all of this? Really, it's just to wait. Sometimes it's better to just wait rather than sell or, get bored and be like, oh, well, this is dumb, whatever. And besides, I mean, if you don't need the money, then you have no problem just hanging on to that and waiting for the stock to do what it's gonna do. That's the great thing about investing, right? You can do whatever you wanna do. You're allowed to not make any money for 3 or 4 years, as long as in that 5th year, you double or triple your money. But of course, those first 2, 3, 4 years, those are gonna get boring if you're not making any money. If you're sitting there watching the market go up and you're going flat, I mean, you're gonna get sick of it. We're all human here. I mean, come on, guys, right? So what's the best thing to do in that situation? Well, that leads us to Brennan's first rule of investing. Just pretend the stock market doesn't exist. But here's the thing. I didn't come up with this rule. Warren Buffett has actually mentioned in interviews before how he rarely compares his performance to that of the stock market on a year-by-year basis. He always says how he just buys good companies at good prices, that whole mantra that he always says. But he's actually said that if you want to compare your performance, a better way to do it might be to do it on like a 5 or 10 year average versus just a year-by-year basis. I mean, that kind of goes hand in hand with what we were talking about earlier, right? With like the whole Wells Fargo thing. I mean, can you imagine if Warren Buffett saw his 1990 performance of Wells Fargo stock and was like, nope, this whole investing thing, it ain't it for me. But think about it, right? Both investors in those scenarios with Merck and with Wells Fargo, they kind of ignored what the stock market was doing. It was going up and whatever, and it's outperforming them in the short term. And they both looked at the company itself. And they were like, both of these companies, they're growing their earnings, they're becoming more valuable, they're gaining more in assets. So I'm gonna hang on to it. There's no reason not to. And it makes sense because at the end, when both of those respective investors sold their stakes in those companies, they both came out with a lot more money than they started with and ended up outperforming the market over that long period of time. So let me talk about a personal example, right? I own this company called Boston Properties. Now, Boston Properties, they are an office company. They own offices, collect the rent on them. It's known as a real estate investment trust, or a REIT. So Boston Properties, between 2012 and 2019, they went from $114 a share to $142 a share. Now, I didn't discover Boston Properties until early 2021, and my thinking with Boston Properties was, since it got hammered by COVID, it was during that period of time when everybody's talking about how, oh, we're never going to return to the office and whatever. In my opinion, all those fears were way overblown. So Boston Properties had fallen from $142 a share to a low of about $73 a share in 2020. So I started buying Boston Properties at $100 a share. Over time, I was actually completely right about the company. They started gaining more occupancy, and in fact today they're making more money than they were in 2019 and more money than they ever have before, just in pure profit. The only problem with that is what the stock ended up doing. The stock went from $100 to about $120. With new fears of a recession and inflation and everything else, the stock has fallen from about $120 recently to about $80 today. So what have I been doing with all of it? I have been buying more shares. In fact, if you do the math on it, the company right now, as of their most recent earnings, is projecting to make about $7.50 in profit for all of 2022. At $80 a share, that's an earnings multiple of about 10 times. But if the stock had gone from 114 in 2012 and only grew at the exact rate of earnings, it would be worth $173 today. That would be an incredible return from the $80 that it sits at today. Not to mention, even if it doesn't go to 173 and we can only get to, say, 142, which was the pre-COVID high, that's still an incredible return from $80. So, I mean, yeah, it sucks, right? Sometimes you get a good company and it's a good stock and the management's doing everything right and it's gonna keep growing over time, and the stock just keeps going down or it doesn't do anything, stays flat, and you're just sitting there just waiting on it. But remember, as long as it's a good company, history has shown us that usually the good companies that continue growing their earnings and growing their worth and their assets and everything tend to go up over time to match that earnings growth and that asset growth. So basically, 9 times out of 10, a good stock can't stay undervalued for its entire lifetime. As long as the company keeps getting more valuable in its assets and keeps earning more money than the year before, the stock is going to be worth more over time. So that's why most of the time it's worth it just to hang in there, because you will end up getting those outperforming results that you deserve from that good of a company. And with that, thank you for watching. Follow me on Instagram for more stock content, and I'll see you next time.